Okay folks, welcome back. This is teaching 3.3, dealing specifically with rejection blocks. Okay, let me ask you a question real quick. What do you see in this chart at major highs and lows? Now, take a moment, pause the video here. Okay, you may have noticed these old highs being violated and a significant movement away from that. And we understand this as a turtle soup or a false breakout. It's important to understand that it's probably easy for you to see these in hindsight when I pick them out on the chart, but you probably don't have that much experience seeing them come to fruition beforehand. So in other words, you don't see them forming in advance. And it's because you haven't spent enough time going through the charts, seeing how they form over and over and over again. Now, obviously, you may not have noticed these. I'm pointing them out to you here. But for some of you that have been working with my content, maybe you've seen other ones. But these two here are the two majors. Okay, so you have two major false breaks above an old high, a nice false swing above a previous high, and then a rejection and a subsequent significant price swing lower. And then we have a false break below an old low, and we have a nice significant price rally higher. But let's take a closer look now. We have an old low here that's been violated. So the sell stops below that low has been ran out. So we would expect repricing on the upside, looking for buy-side liquidity. The market trades above an old short-term high here, pairing up the buys from the previous low with buy stops they can sell to with a movement above a previous high. Each one of these is a turtle soup, the first being a turtle soup long, the second being a turtle soup sell. Down here we have an old low that's violated where sell stops have been ran out. We have an old low over here where sell stops have been ran out. We have an old high here where buy stops have been ran out. So you can see significant price swings at looking at the daily chart like this, and it gives you a great deal of prognostication. When you anticipate every time a new high or low is formed, we expect some measure of rejection. That's the first anticipatory price skill set that you should be working towards developing, because it's the hardest one to groom in your trade psychology. Some of you probably understand that higher high failure swing and lower low failure swing, or turtle soup long and turtle soup buy. Some of you probably aren't aware that there are other distribution and accumulation patterns that take place at highs and lows. So let's take a look at that now. Okay, we're going to look at a bearish run on buy-side liquidity, or a turtle soup sell. Now, obviously, when you look at this price action here, it should be pretty obvious after studying my material. We have equal highs that's been ran out. So there's buy stops above those equal highs in there have been ran out here. We would reasonably expect to see what form? A sweep through and a potential rejection and trade lower. And that's what you would see here as an example. Now, some of you probably can see this relatively easy in the chart formations and how a previous high or a previous low has been violated, and then a subsequent rejection and a retracement of a longer magnitude. But I want to teach you tonight a different approach to looking at distribution and accumulation. Okay, look at this pattern here. Okay, we're going to talk about a bearish rejection block. And before we get into it, the ideal setups are found in major to intermediate term downtrends, and the bearish rejection block is when a price high has formed with long wicks on the high or highs. It can be more than one candle that forms a high of the candlestick or sticks and price reaches up above the body of the candle or candles to run the buy side liquidity out before the price declines. As you can see, there are several wicks here forming potential resistance. Now, a classic chartist would look at this as a potential continuation pattern in the form of a bull flag. We taught earlier in this mentorship the falsehoods that come along with some of the classical chart patterns. Price does not move around because of animal patterns or supposed geometry in price action. It's based on the orders. Okay, and looking at this price action here, if this is near a overall longer term resistance level or trading into a bearish order block or an old low that may not be seen in this sample size of data, but you can see price has ran up higher for a good number of candles. Then it starts moving into a small consolidation. But more importantly, I want you to look real close. Is there a strong likelihood that this is going to go higher based on a continuation pattern of like a bull flag or a pennant, or is it showing underlying distribution? Notice there's no higher high here, or is there? Take notice of the highest body in this formation and the most recent candle that traded through it. Price pushes above the previous highest candle's body. Seen right here, that run above the highest body's candle produces the distribution seen in the chart here. Price does not need to make a higher high to have a failure swing. By looking at the bodies of the candle, which is one of the first things I taught when I started teaching online how the foreign exchange market operates, you don't need to have a great deal of understanding about candlesticks except for understanding where the open, high, low, and close is. And if you follow every swing high and low, and you chart the open, high, low, and close, and you deal specifically with the opens and closes, you'll be able to ferret out what distribution and accumulation takes place at these turning points. As you can see, the real pattern here is from this previous highest bodied candle, then the subsequent later higher drive higher. This candle here, prior to this candle moving up, this candle was the highest bodied candle. We're not paying so much attention to the wick. The wicks highlight the idea of this pattern forming. This pattern here, shooting above this previous body or previous close, this is the highest close or highest open in this swing high. This candle here drives above it, clearing out the buy side liquidity, and then rejection. Basically, what we're seeing is distribution. So what is it really to see a rejection block, and what does it look like? I have a crude depiction here with a single wicked candle. Now this is going to be better understood when there is multiple candles that form the high and multiple wicks. You're still looking at the highest close or high. You're still looking for the highest open or close inside the swing high that forms. The wicks are just drawing your attention to a potential rejection block. When you see the wick, you have to build the parameters for the rejection block by finding the highest high and the highest open or close in the swing high. It does not matter if the highest candle is a bearish or bullish closed candle. You're still looking for the highest high with the highest open or closing price into the highest wick. That frames the rejection block. So once we have the rejection block defined by the highest wicks high and the highest open or close in the swing high, that frames the rejection block. And in your mind, you should be viewing it like we have here, a candle all in of itself. This range is going to be a selling block. In other words, we treat this as a bearish order block. When price trades back up to the low of that range, that is your trigger. Now you can do one of two things. One, if you're aggressive, you can sell at that price and put a significant stop loss above that particular price level. Or you can wait for it to trade through it a little bit, and I'll leave that up to you in terms of all the additional insights that we'll be sharing over the mentorship about entry patterns. Or you can wait for it to trade above that level, and if it moves a significant amount above that highest open or close, in this case is the highest close of that bullish green candle, if it trades above that particular level and it does not trade to a higher wick high, you could be a seller on a stop below that level. So that way you can be selling on weakness. This is one of the few times I use selling on a stop as an entry pattern. What it looks like in the charts, here's one example here. We have a candle with a wick. We use the highest body reference point being open or close. In this case, it's going to be the open. And price trades above it just a little bit, violates that, doesn't make a new higher high, and it makes a run eventually for the sell side liquidity below the marketplace there. So rejection block for the bullish side of the marketplace is obviously in ideal scenarios, it's in major to intermediate term uptrends. And a bullish rejection block is when a price low has formed with a long wick or wicks. It could be formed over multiple candles. And the low or lows of the candlestick or candlesticks, again, it's not limited to just one candle. And price reaches down below the body of the candle to run the sell side liquidity out before price rallies higher. Again, we frame the rejection order block, in this case the bullish rejection order block. It's going to be the lowest wick low and the lowest open or the lowest close that makes that swing low on the time frame you're looking for the pattern. Once you identify that, you have framed the bullish rejection block, and we treat this just like a bullish order block. When price trades back down into the high of the block, we can be a buyer just below it, or we can wait for price to trade through it. If it's a little bit longer term time frame, we can wait for it to trade through it by a little bit, and then we can be a buyer on a stop just above that particular level here. Again, the trigger is that high or the lowest open or the lowest close in that swing low. But the key is it has to be a swing low that has a wick or wicks. In price action, this is what it looks like. Price makes a previous low with wicks. Market comes down, trades down just below the bodies of the candle. And then we see a strong rejection because of a massive accumulation that comes in. It's not always required to see a higher high for a failure swing, which would be a turtle soup sell, or requiring always a lower low for a rejection for a turtle soup long. We can anticipate levels like this to be taking profits at, if we're short in this case. If the market had been trading in our favor on another type of setup, we could look at the take profit objectives to be covering the short just below the lowest open or close in the previous swing low. Don't always demand that price gets below the wicks. It's really the bodies of the candle that the closest thing to institutional understanding you're going to get when you're using retail price delivery mechanisms like the platforms we have to trade through from a retail perspective. Hopefully this has been insightful. We're going to have a lot more information as we go along and we start talking about specific entry techniques. We'll be revisiting all these things as well and amplifying them. But I want you to go through your charts and look for examples of rejection blocks in their subsequent price moves after their formation. Till next time, wish you good luck and good trading.